The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and or legal advisors before implementing any transactions and or strategies concerning your finances. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of October 21st. If you're new here, welcome. If you're a regular guest, thanks for joining us again. As usual, my goal for this series is to use my background in economics to help you better understand the economy and the financial markets so that you can navigate the changing financial landscape. And with that said, let's get ready to hit the books and get up to speed on the markets. Last week, we saw all three major stock indexes finish the week up about 1%. The S&P 500 and the NASDAQ were a little shy of that value, but the S&P 500 and the Dow Jones Industrial Average both established new record high levels. The NASDAQ finished the week less than 1% away from its own record high. So this week, we'll continue to watch all three of those and see where they take us. The 10-year Treasury yield finished the week about where it started at 4.08%. In economic news last week, some of the biggest information was the retail sales update. So the most recent retail sales update had lots of things to be excited about in the report, including increases that it vastly exceeded analysts' expectations. In fact, if we exclude the auto and the gas sectors, the actual retail sales gain was more than double the analysts' expectations. Retail sales gained 0.4% in the last month and 1.7% in the last year. These are both exceptional gains. These both exceeded analysts' expectations. But in a lot of ways, more importantly, we saw the diffusion of these retail sales gains spread across just about every sector in the economy. I've mentioned diffusion before, but it's important to keep in mind that an economy that's only growing in one sector while others are suffering or stagnant isn't sustainable. So the fact that we're seeing the retail sales spread across a variety of sectors helps us to understand that this may be a more long-term, more sustainable growth than what we might see otherwise. In last week's video, I mentioned that we dive a little deeper into housing this week, so we'll start with construction. The National Association of Home Builders Housing Market Index increased in the last period, and we're seeing an increasing growth in home builder optimism. We've seen an increase in single-family homes construction, as well as permits and housing starts, although we've also seen a decrease in the multifamily construction zone. The reason that housing construction is such an important place to start is the fact that some experts estimate that we have as much as a 4.5 million unit housing shortage in the United States currently. The National Association of Realtors actually maintains a housing shortage tracker that you can find online. And one of the important takeaways is that these housing shortages tend to be very regional. So additional construction and additional optimism is definitely a positive indicator. But we'll need more time to watch how these markets develop to see if this construction is taking place where the shortages and the communities are in the greatest need. In addition to construction, we also need to consider the mortgage markets and the sales markets, since both play a big part in the housing market in general. Mortgage rates have been rising recently. Mortgage applications and refinance applications have been falling, which is a natural relationship and reaction that we would expect to see. We've also seen that existing home sales have fallen recently, and median home prices of the homes that are sold have been increasing. Median home prices have increased over 3% and have actually increased every month for the last 14 months consecutively. Home sales, at least existing home sales, have also fallen in the last few months. So as we watch the housing market, it's important we keep in mind The supply of housing and the demand for housing are both important dynamics. As the supply of housing increases or decreases based on homes coming up for sale or new homes being constructed, we have to contrast that with the demand for homes, which is a function typically of mortgage rates, home prices, and the financial conditions which allow people to actually be approved for those mortgages. So as we move forward, the housing market, being one of the more complex aspects of the U.S. economy, will continue to get a lot of attention because, as I've mentioned previously, it happens to be one of the stickiest or one of the most prolonged aspects of inflation that we've observed. In addition to that, of course, housing is essential for households and workers to operate in other economic ways. So each week we'll probably have ongoing housing updates, but if you have a question or a concern or a specific aspect of the housing market that you'd like us to discuss, remember you can always throw that in the comments, and I'll do my best to include that in next week's video. One of the topics that we're watching closely this week is 10-year Treasury yields. We've actually seen the 10-year Treasury yield increase significantly this week. We've also seen the yield curve between intermediate and long-term Treasuries steepen. And over the last few weeks, we've seen a pretty significant rally in the value of the US dollar. All three of these things are interconnected because they're all three a reflection of the market's concern or lack of concern about the potential of a recession in the near future. The yield curve had previously been inverted, meaning that the yield on short-term treasuries was higher than the yield on long-term treasuries, and it had been inverted since July of 2022. So in recent, as we've seen this yield curve flatten and then proceed to steepen, this aligns with the other factors indicating, one, that there seems to be a growing sense of optimism as to the reduced likelihood of a recession and the continued strength of the U.S. economy. These three things could also reflect the fact that there may be a resurgence of inflation as the economy continues to grow, and the Federal Reserve potentially continues to cut interest rates. There is some growing concern that the inflation will return to the economy as a result. And last of all, the Fed cutting interest rates has a lot to do with anticipation and the predictions of what these markets look like in the future. As we continue to receive strong economic reports and strong financial reports from the corporate side of the economy, the growing consideration is that the Federal Reserve won't need to cut interest rates as quickly or by as much as we originally anticipated. So the potential for returning inflation, the continued growth of the economy, and the potential for a reduced amount of Federal Reserve rate cutting have all put upward pressures on these long-term fixed income securities. Earlier this week, we received an update from the Conference Board on the Leading Economic Indicators Index. Remember that the leading economic indicators captures information about manufacturing, consumer sentiment, interest rates, the stock market, and many other topics. The Leading Economic Indicators Index is sort of like a warning sign or an alarm to help us understand what the economy may look like in the near future. Unfortunately, this update showed a decrease in the index, and this update marked the 31st consecutive period without a month-over-month gain. So when this index spends this much time in the negative region and showing this many stagnant or declining values, it typically indicates that a recession is coming. Although this index has been indicating a recession for well over a year now, we have yet to see one develop or take hold. The ongoing question is whether the index is somehow overlooking critical information, or whether the recession is still on its way and just simply hasn't arrived yet. On a more positive note, so far in our third quarter earnings reporting season from corporate America, we've seen a significant majority, in fact over 79% of corporate reports, indicating a positive economic surprise, meaning that the actual performance of these companies in the third quarter exceeded what those companies had expected to do in the same period. These strong corporate profits, corporate earnings, and corporate growth suggest that the ongoing growth in the stock market may have a good distance to go. Coming up later this week, we'll get reports on durable goods manufacturing, which are goods that are not easily or quickly replaced, such as appliances like refrigerators and stoves. We'll also get information on consumer sentiment, some final updates on how consumers are feeling about inflation and about the financial future. And last but not least, most states that offer early voting will have polls open by the end of this week. So we may have some topics to discuss next week relating to the election, but most likely over the next month, over the next few updates, the election and the implications of the election will slowly play into our updates as well, as I'm sure many of you are wondering about. Coming up in the slightly more distant future, next week we'll see 175 companies reporting their third quarter results. This is actually the single largest week in the third quarter reporting season and should give us a lot of insight as to where the economy in general, beyond just the financial and retail sectors, has been in the third quarter, as well as where they anticipate being in the fourth quarter of 2024 and into 2025. Next week will also be an exciting week for economic data. We're going to see updates on gross domestic product, employment, and inflation, all within 1 week. We'll receive the preliminary estimates for third quarter GDP. We'll receive the end of month measures for the labor market and unemployment. And we'll also see the personal consumption expenditure, which is the Federal Reserve's preferred measure of inflation. These are important in themselves, but they're increasingly important because the next interest rate decision by the Federal Reserve is coming up quickly, and these three data points will most likely play a large part or an outsized role in their ultimate interest rate decision. As usual, we'll be watching this as well as any other economic and financial updates that could be released throughout the next week. That way we can bring you all the up-to-date information and help you stay up to speed on the markets and the economy. If you found this video helpful or informative, don't forget to like and subscribe, turn on notifications so that you know when our newest content has been dropped, and come back to join us again next week. Thank you, and have a great week.